And we are really firm and strong believers that if you're an LP investing in early stage venture, company creation needs to be part of your exposure. It's a changing trend in how early stage venture is being done, and it generates some massive alpha. We fairly consistently see triple digit net IRRs in the early years of our managers. And I know IRR is a time bound metric, but it just shows you the power of that 0 to 1 muscle that a lot of these company creators have.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing from the emerging manager perspective. We have talked with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital and startups. I'm especially excited about today's episode because we'll be talking to Francisco Gomez of Volt Fund. Volt Fund was founded in 2021 and invests exclusively in company creation entities, company creators, otherwise known as venture studios. Volt defines a company creator as an entity that serves as the founder or co-founder across their portfolio. Investing in this space since 2015, the leaders of Volt Fund strongly believe that company creation funds have business model advantages to scale innovation and build high-quality, resilient companies that create portfolio-level alpha more effectively. Francisco is a partner at Volt Fund with almost 12 years of financial experience and 8 years of private equity experience. At Volt, Francisco is focused on pipeline development, diligence, and regularly working with their underlying portfolio of company creators. Prior to joining Volt Fund, Francisco was a director at Allocate, a digital platform for private alternatives where he worked closely with fund managers across the different stages of venture. Francisco and his partner, Sarah, are also worked together at Centrifuge, where he worked as an associate and focused on early stage venture. During his time as an allocator, he has met with over 400 funds across the country and led diligence on over 40 investments. Francisco, thank you so much for joining us today.
Tim, thanks so much for the kind introduction and for having me today. I'm really excited about the conversation.
Likewise. Can you share your journey to the Volt Fund? What led you and Sarah to focus on company creation rather than traditional venture capital investing?
Yeah, absolutely. So Sarah and I have known each other and worked together for the better part of 7 years now. And as you mentioned, we used to work together at an early stage fund of funds, Centrifuge, where we focused on seed and Series A managers all across the country. We had a largely corporate LP base there. Kind of Fortune 50 companies across consumer, hospitals, insurance companies, and so on. And we invested financially and strategically for them. And a little bit on the strategic front, we started to find this company creation venture studio model, at the time, 2014, 2015, kind of not fully knowing what it was. We started to dive in and made a handful of venture studio investments out of our Centrifuge funds. And we started to see just some really interesting patterns of outperformance, but also, as you mentioned, some business model advantages of how studios kind of, ideate, incubate, and build these companies from day zero. So Sarah spun out from Centrifuge to start Volt Fund, and kind of in the very early innings of Volt Fund, while Sarah was launching, I was at Allocate, working across the whole span of venture, from pre-IPO all the way to solo GP Fund 1s, and kind of everything in between. And I knew that I wanted to be more on the emerging side of venture, working with smaller funds, with managers that were really Fund 1, 2, 3, kind of like in the early inception of like what their firm was going to become. And the opportunity came up to start working with Sarah again, and we've been building Volt together now, for a handful of years, and it's been a great journey, kind of working our thesis that this is a better business model and that there's some performance advantages to it, and we're already starting to see it play out in a pretty meaningful way in our Fund 1 portfolio.
I feel the timing probably was very opportunistic and just perfect in the sense of Snowflake IPO'd a few years ago, and I feel like Snowflake is probably the epitome of a company creation venture studio. Has do you feel like you all have massive tailwinds?
Yeah, yeah, absolutely. I feel like we have some pretty big tailwinds right now on a couple of different fronts in the company creator model specifically. And then for Vault Fund, for us, it's a bit of a blue ocean opportunity right now because we are, um, you know, pretty much the only fund of funds focused exclusively on venture studios and company creators. So we have a bit of flexibility in terms of the people that we're meeting in the market, the structures that we're seeing. But I think some of the really interesting tailwinds right now is some are technological. So in like '06, '07, we went through this like technological revolution, basically like AWS, the iPhone, a couple of different factors that brought the cost of creating a company down from like a couple of million to a couple 100,000. And then now, obviously, we're going through this kind of like GPT AI revolution where it might go from costing a couple 100,000 to a couple of tens of thousands to build a business. And if the studio and company creator model can like really harness that power, um, the biggest power of the company creation entities is efficiency, both in time and capital, right? And I also think there's this really interesting wave of talent that's coming onto the market right now that's looking to build their next thing. And it's the perfect time for studios to have dry powder, improved technological tools, and an improved talent pool in the market to really build kind of the next generation of great companies. And I also think one of the tailwinds is, people are starting to see this kind of like bifurcation of venture, right? There's these huge, massive firms, multi-billion that are almost becoming more like wealth management platforms, right? And that's a bit of your like venture beta. And then there's this whole new trend. It feels like, over the past like 12 to 18 months of people also looking for their venture alpha in smaller vehicles, more emerging managers. And I feel like that squarely hits with what company creators can provide, really that venture alpha side of an allocator's portfolio. So I feel like definitely tailwinds on a couple of fronts, technological in kind of how we can build these companies, but then also just from an allocation perspective, I know there's increasing amounts of money going to the big players, but there's definitely a trend in the narrative of people being really interested in kind of smaller, more emerging type vehicles that can generate real alpha in their venture portfolio.
Fascinating. You mentioned you all use company creators, but a term that's often used are also startup studios, venture studios, company builders, and venture builders. And my understanding of this space is that you all are betting on the trainer who's bringing together the horse and the jockey, and that means you're betting on the trainer that is going to find the right idea and the right founders to go after that idea. Is that a good read or not?
Yeah, yeah, absolutely. So Sarah and I have kind of spent a lot of time thinking about terminology and kind of what we should even call, what we should even call these firms. And startup studio, venture studio has kind of been the general terminology. But what Sarah and I were seeing was essentially a lot of venture studio branded entities that weren't really building their companies, right? That were more like maybe an accelerator or maybe almost like a really, really early pre-seed investor. And that's not like quite the business model that we are going after. So we shifted to this like company builder, company creator terminology because the firms that we are typically investing in are either founding the company or co-founding the company. And to your point of kind of like, I think that analogy is perfect of like the trainer bringing together the horse and the jockey, right? Um, in some scenarios for studios, like they ideate the company internally, do some like early ethnography, customer validation, and bring in a CEO. Right? Hey, we have this idea. We validated the general premise that like this is a problem, and that there's people that are willing to pay to solve this problem. Let's build this company. And then there's also cases where you can co-found a company, right? Where a founder comes to you and they're like, "Hey, I've been chewing on this idea, or I have this idea from my prior professional life of a problem that needs to be solved, um, but I want to test it, right? I want to make sure that this is a real thing, or I want to have a co-founder, like an institutional co-founder, in building this together." So that's kind of that's the threshold for us, right? Like you need to either be founding the idea or you need to be co-founding the idea. And that's why we've started using the company creator and company builder terminology. Um, and it's been really interesting to see the category evolve, but also our own strategy, right? Like when Sarah and I first started, it was like you had to found all the companies. We weren't really working on the co-founding model. And as time has gone on, some of these co-founding models have actually become the best companies in our underlying portfolios. I think there's a very real advantage where like an experienced founder, that's been in the trenches before, whether they got a successful exit or whether they didn't get to a successful exit, they know how hard it is to build a company, right? When you're having to think about, okay, developing MVP, hiring the right people for the engineering team, hiring the right people for business development. Oh, and on top of that, by the way, you're running out of money, so you need to go raise capital, right? There's a million things going on at once in a startup's life. And there's a lot of really seasoned founders that know that working with a company builder or a company creator as their institutional co-founder can kind of take out a lot of that operational noise, so they can focus really on like hammering just product, customers, capital, right? And everything else, there's the cogs that help you turn those wheels.
I think for a lot of people in startups and venture capital and the wider population aren't aware of so many fantastic venture studios. So I'm going to name a few that I know you're very familiar with. There's Pioneer Square Labs, Expa, Science, High Alpha, Atomic, Human Ventures. Um, Sutter Hill does this a lot. And you just mentioned that it's not a requirement that the studio or the company creators found it. They can also co-found it. Are there other criteria, as in like, do you evaluate venture funds that are doing 50-50 or 80-20? When does it become that's too traditional venture capital versus that has enough of a venture studio company creator model to it?
Yeah, yeah, and this is something that we spend a lot of time thinking about at Vault, because there is this rising trend of early stage venture managers increasingly doing incubations or company builds out of their portfolio. And it's really interesting because a portfolio of 20 companies, maybe two are incubations, and oftentimes those two will return a significant portion of the fund, if not the whole fund, obviously depending on the size of the vehicle. So this is a whole kind of emerging sector of company creation that we've been talking about. In the past, we've kind of held the line to it has to be 75% incubations and then 25%, kind of opportunistic external investing. That's something that we're kind of evaluating for our fund two and thinking about. But I think as part of our like thesis and our belief in this business model, the majority of the capital and the portfolio has to be exposed to companies that are being built internally, just because of some of the things that we've been touching on, right? The kind of main one being if you hit on something that is a real problem that people are really willing to pay for, that you can really build a company around, your cost basis is near zero, right? It's not zero, but it's pretty close to it. So then you have so much optionality in the future of, hey, is M&A an opportunity? Are secondary exits like partial secondary exits an opportunity? Kind of what does the life of this company look like? But it's been an interesting kind of evolution to watch of people, both emerging and emerged, like blue chip firms, kind of coming, towards the incubation company creation side of things as they start to see the alpha from, these huge companies that are being created. Like you mentioned, Snowflake or like Atomic created Hymns. Atomic also created OpenStore. Science created Liquid Death, just to name a couple. So I think people are starting to really see the alpha from creating these companies, and it's something that we are going to keep an eye on at Volt. But definitely, we need the majority of the exposure in company creation work.
We're talking, I truly believe, at the edges and the very cool edges of venture capital. You mentioned already some companies that are company creator, venture studio ones. I'll throw in a few more. Jiffy, Aircall, Dollar Shave Club. And then what's really interesting is some of these very large funds, like General Catalyst, have actually had a history of company creation, Livongo and Kayak. And then now we're seeing 8VC, a fund that raised basically a new $1 billion fund, do a lot of defense tech and dual use incubation. And so just in general, it feels within venture, there's firms getting bigger and going earlier. Are you seeing that or not?
Yeah, definitely on the venture side, and it's an interesting dynamic to watch, right? Because um, kind of these, multi-billion-dollar big firms have life cycle vehicles that they can continuously invest in these companies that they're incubating, right? But early stage managers are also getting bigger, right? To have reserves to do follow-on, to do crossover investments, to double down into the companies that they know the best. But it is really interesting to see, AVC doing, company creation incubation work. There's programs like Sequoia Arc and so on that, maybe they're not quite company creation, but they're starting to get very, very close, to your point, kind of on the edges of that. Um, so it is a really interesting dynamic to see venture scaling, but also coming earlier. Because one thing that Sarah and I also talk about a lot is the scalability of the company creation model, right? Um, you can't build, 100 companies a year because you want to keep high quality on both the ideation, the validation, and the talent that you're bringing in, right? Like you need real venture scale CEO talent to help you build this company and also the team around those CEOs. So it's interesting, kind of as the firms scale. You have to scale the amount of builds, you have to scale the amount of capital that you're pumping into them, and how does that change some of the like alpha advantages that we see from the model? Kind of a little bit TBD, to be candid, but it's a really interesting evolution. And some of these, really large firms, like General Catalyst and a handful of others, are also starting to do what's essentially company creation, but in private equity platforms, right? Like they're ideating these like parent co platforms that leverage some sort of like proprietary tech asset, whether it be AI or not, and kind of build a private equity roll up under a proprietary tech asset, right? So this whole notion of like kind of ideating from inception, validating, having like proprietary assets that are going to give you differentiation in the market, um, is starting to prove that it doesn't just work in venture; it also works in other assets like private equity. And I think, you know, even some of the biggest firms in the world are starting to see it.
What I find fascinating about venture series company creator models is that you all go at the very beginning and not even at zero, but sometimes at -1. Like it's idea decision creation. But what's really interesting is if you go right past the zero mark, then you have a proliferation of incubators and accelerators. And their model is scale. You look at YC, Techstars, they're not just creating tens of companies or 50 companies, they're creating hundreds of companies a year. And then obviously you go to pre-seed funds, and they have to take a lot of shots on goal simply because there's just like you need lots of shots on goal to find your unicorns. And so it's really interesting that you go zeros, the closer you get to zero, the more shots on goal you have to take. But then once you get to zero or -1 with venture studios, there's only as you said, a certain number of shots you can take because there's not that many unicorn ideas or types of companies that you can build around that. Thoughts on that?
Yeah, yeah, and honestly, this has been a huge learning for us at Vault, and I think it's one of the biggest misconceptions from the market and like traditional early stage venture against the company creation model. That kind of like how much value are these company creators adding, or how much work are they really doing? Vault has performance data on a little over 350 company creators around the world. And basically, what we've started to land at is, as a rule of thumb, and I know it changes like, sector to sector and team size and so on, but one company per partner per year is about the right scale where you're really building the highest quality companies. And the reason that Sarah and I, have built a portfolio of underlying managers that are like pretty concentrated is because the whole notion of this model is efficiency in time, efficiency in capital, but also high quality, right? So we want our managers to ideate hundreds of ideas, but kill them fast and kill them early and kill them cheap, right? Like it might only take $10,000 or $15,000 to vet out like the very early innings of like a consumer company, for example. Obviously, if you're building like a biotech, it would take more than that. But what we're really kind of seeing from the best company creators in the world is they ideate a lot, but then they validate and they kill very quickly and with very little capital. And kind of once they're at this point where, hey, this is a real problem, there are real customers here, and we have a real right to win in creating a solution alongside a world class CEO, then they deploy, a material check to really kind of get the company off the ground. And what that is coming to in kind of like real world figures, right, is Sarah and I have spent pretty much our whole career before Vault looking at traditional early stage managers. Traditionally, you're overcoming 30 to 40% capital loss in an early stage venture portfolio, give or take on those numbers. The really high quality company creators that we're seeing are either in the high single digits or in the low teens on capital loss in their portfolio. And what's driving that is the rigor behind the ideation and the validation before they deploy meaningful dollars into an idea. And it kind of leads to a couple of advantages, right? When you're not losing 30 to 40% of your capital, you have less of a hill to climb before you can start returning money to your investors and getting carry for your team. But it also leads to really high quality companies because the companies that are making it out have been really, really deeply thought through. They've been really deeply validated, and they have a world class CEO that can take them to market, right? Not to say that there aren't volume strategies that could work, but Sarah and I have just started to see a pretty strong trend of performance in concentrated strategies because building companies is hard, right? Building a company in any sector even when the market is up and to the right and you have all the customer traction in the world and you have all of the follow-on capital in the world, it's still hard. Every day of building a startup is hard. So this notion, of kind of like how much do company creators add? The ones that are very good at it, they add a lot. Operationally, in getting follow-on capital and helping you see some of the hurdles that might come up in the business, and really leaning in and helping a lot means that you can't build a lot of them at the same time.
So you all have seen hundreds, close to 500 funds that are focused on company creation. Can you talk about what's happening in the market? Meaning, is this expanding beyond the U.S.? Like, which geographies outside the U.S. are seeing this? And also, I've read some of your material. You all are partnered with some deep tech funds, not just like companies, firms like Atomic. So, can you talk about the market overall?
Yeah. So this model of company creation really works across a lot of sectors, but where it's most widely known is actually in biotech and therapeutics, right? So much so that firms like Flagship or Atlas they're just known as early stage venture, right? But most of their portfolio are actually incubations, company creations, right? This whole idea of kind of like de novo company creation in biotech therapeutics is almost accepted as like the standard. This is how early stage venture works, which is a really interesting dynamic. To your point, it's spread to other sectors like consumer or SaaS. There's players in deep tech. There's players in synthetic biology, in climate tech. It's really kind of proliferated, but it's also proliferated internationally, which is amazing to see. Right, Sarah and I have met with company builders in Africa, Southeast Asia, Europe, Latin America. It's really kind of everywhere, and some of the pockets that are getting really interesting is like Wavemaker, for example, is doing really great work in Singapore. They're focused on climate technology with like application tomorrow, right? Not technologies that could be applied 10, 20 years from now. So, for example, like figuring out how to use less water in rice agriculture in Southeast Asia, which is a really interesting technology. Or, there's a lot of creators doing really strong work out of Europe. Like, for example, NLC Ventures out of the Netherlands, kind of working in the healthcare space. Builders also out of the Netherlands. There's Marble out of Paris, working on climate tech, and there's just so many of them kind of scattered across Europe. And then in Latin America, there's a couple of different players also working on building companies. So it's been really interesting to see this world of company creators expand to, I'm pretty sure GSN is now saying there's a little over 900 around the world. So the model is definitely kind of, spreading geographically across sectors. And I think one of the really interesting things about it is with this flexibility to be either a 2 and 20 fund or an LLC holding company model, the barriers to entry are low, right? Because you could raise a couple of $1 million, $1, 2, $3 million, and get off the ground, start building a portfolio, right? We've seen some maiden holding companies raise $2 million, go out and build 5 companies with that, and start to get some really serious marks. Over 10x marks on their portfolio. So it's really really cool to see the proliferation of the model, but then to also see some of these bigger firms also starting to look at creating their own companies internally, like you were mentioning earlier. So it's more of a world for us to canvas at Vault, but I think it's a great problem to have.
You mentioned GSSN. Just for folks listening, it's Global Startup Studio Network. They create a lot of great content. I also highly recommend the content that Francisco and Sarah have created. If you go to their website, I'm looking at one screen on one of their PDFs. It's the Venture Studio Primer. Highly, highly recommend that piece of content. The other one that they've done that Francisco just referenced is understanding the impact of company creation fund structures, because venture studios can have very different fund structures, a very complicated topic, and one that they spent 6 pages writing on. But Francisco, if you could, at a high level, can you talk about the two different fund structures that you typically see for company creation studios?
Yeah, absolutely. And thanks, Tim, for mentioning our content. We put a lot of time and work into kind of compiling all this data, and we always aim to share best practices about the category, right? Like we're all still learning, we're all still evolving, and Sarah and I definitely want to be kind of a part of that learning catalyst. And on the structures, it's probably one of the things that we spend the most time diligencing. Um, you know, when Sarah and I were looking at traditional early stage funds or even pre IPO funds, everything is pretty much 2 and 20. Maybe there's some sort of like step up or catch up on carry. Maybe there's some accelerated fee structure. But at the end of the day, we're all looking at like LPGP structures 2 and 20, right? And that's what allocators have been the most comfortable with. What's really interesting in the company creator world is that we also see holding companies. Typically, they're structured as LLCs that have passed through ownership into the C corps, which are the companies that they're creating. And our Fund One portfolio, we have exposure to both structures, and we've started to see just some really interesting benefits on the holding company side of really, really strong LP GP alignment on a couple of things, right? So these holding companies operate on a OPEX basis as opposed to having like a traditional management fee. But what's really interesting is when structured appropriately, most, if not all, of the OPEX is value accretive, right? So if I spent $750,000 worth of the team's time, kind of working on this company, getting it built, making a preferred investment, I'll get my preferred ownership, but I'll also get common for the kind of sweat equity OPEX that I spent ideating, validating, and building this company. So what it ends up looking like a lot of the times is virtually no fee drag for LPs, and then the alignment that you as a GP, me as an LP, or however we want to call it, since it's a holding company, um, we are the same share class, we have the same exposure to the companies, and when money comes in, kind of everyone around the table wins from secondary distributions, from full distributions, however the exits happen in the portfolio. Um, and kind of what that model, the holding company model, also allows is, off of a 2% management fee, it's hard to build a company creation engine with less than like a 40 or $50 million fund size, because you're taking 2% fee, right? So how do you resource a team? How do you make sure that you can provide the right resources to the companies that you're building and supporting? Where in a holding company model, I mentioned you're working off OPEX, right? So you could raise as little as $5 million and still build a viable team to build a portfolio of companies. So it's been one of the biggest learnings for Sarah and I, that there's this diverse world of structures, and I feel like where we've landed is both models work. Um, we have started to really lean into the holding company model. Um, but at the end of the day, structure is not what gets LPs across the finish line, right? We always say structure will never get an LP to say yes, but it can make an LP say no, right? So our whole mantra is just like keep it simple. If somebody can't look at it and decide kind of ballpark what it is in 10 or 15 minutes, and it's probably too complicated, right? But the structure side of the business has been just a really interesting evolution for us. kind of the more time that we spend in this category.
So fascinating from my perspective as someone who has incubated and co-created two companies and in the process of doing a third. As you mentioned, there's a challenge around the management fees. And so far, um, maybe too much information, we have funded our company creations through management fees. And I feel like the traditional model incentivizes fund managers potentially to incorporate the company sooner than they should, just so they're not using their management fees to get it up and running. They're like, okay, we quickly validated it, maybe too fast, and then go up and running. Um, I'm curious around structure. Um, what do you find to be a sweet spot of fund size for company creation studios? Like is 5 million is probably like the very like minimal you need, but like 200 might be actually too large because one partner per investment per year. So is there a sweet spot, a great sweet zone?
Yeah, yeah, and this is a really interesting question because we have a pretty like large array of manager sizes in our own vault fund portfolio. Um, and there's kind of like a beauty and a curse to being capital constrained on the really small side, right? Like if you're a $5 to $10 million holding company, you can build a concentrated portfolio of companies, but you can't really support them with follow-on capital. So, kind of the beauty of that is you have to go to market and you have to get marks, right? Which kind of brings a couple of things. It brings marks for your LPs and your team. It brings external validation that there's more often than not traditional VCs in the market that think, this is a good company, this is a good CEO, I want to back this. And we've seen this kind of across our portfolio and outside of our portfolio, that studio companies can get some really great follow-on investors. Um, and then the kind of the curse of being capital constrained is just you can't double down and kind of preserve your ownership in some of your very best companies, right? Um, with that being said, when you start to get too large, what starts to happen is this like multiple compression because of where your capital exposure is, right? Like if you're a $500 million fund, how much of that is actually being deployed at like the inception near zero valuation entry point? Some of it, right? But a lot of it is being deployed in like Series B, C, D follow-on rounds into companies that like intimately and that you have information asymmetry on. So like there's still strong investments, but it's not going to generate this, kind of 10, 20, 30, 40x that you can see from some of these like early kind of near zero entry points. So we've seen a lot of holding companies kind of landing around the 15 to 20 million mark, which feels about right. In biotech and therapeutics, a different story, right? You need some more capital there. So probably closer to like 75 or 100 on the holding company side. And then on fund size, we're starting to see kind of a concentration of managers. I would say between, like this is a bit of a broad number, but kind of like between 50 and 150. And some managers that are more established, more mature, are kind of scaling above that as they do an incremental amount of crossover investments. Um, but to your point, it's you can't really scale the number of companies. So kind of when you're a company builder and you scale your firm, um, you don't necessarily scale the volume. You just scale the life cycle support that you provide to the companies, which I think is also a really interesting wrinkle, kind of like in the story of company creators, right? I feel like in the past, venture studios, company creators have been kind of smaller firms. Traditional VCs are like, hey, they built the company, but they don't really have any money to follow on. So do I want them on the cap table? Um, which has been kind of a push and pull argument for a couple of years. But as these firms scale, like for example, Atomic, right? Atomic can support their companies pretty much through the entire life cycle, much like a traditional, scaled venture capital firm could do. So there's pros and cons to being small and to being big. But I would say, like, long answer short, we're seeing a convergence of like holding companies in tech around 20 million, holding companies in biotech therapeutics 75 to 100, and then fund sizes ranging probably from 50 to 150.
Fascinating. The the content you all have created, in addition to what you've shared here, reminds me of just like how much is changing within the company creation. Like, sure, venture's changing, but I feel like every month in company creation, there's something new. Someone's innovating on a new model. And that takes me to a conference that you all hold called the Global Takeoff Summit. And I've got to believe that is the event where you bring together the best minds in the community, sharing best practices. Can you talk more about how it started, how it's going, and why you all hold the conference?
Yeah, absolutely. So Sarah and I launched the conference last year. We had our kind of, maiden global takeoff summit in 2024 in New York. We had planned to have 100 folks there. We ended up having a little over 120, but we had over 200 register. And the room was about 50% LPs, about 50% company creators. And the vision that Sarah and I had was to build kind of a global convening where the best company creators and LPs that are either actively investing or interested in learning about the category could come together to talk about headwinds and tailwinds. Right. A lot of my answers today have been kind of focused around like what works in the venture studio category, which there's a lot of it, which is why Sarah and I are huge believers, but there's also things that have a lot of room for improvement, right? So we wanted to bring together kind of the world's best company creators to just talk about what's not working for you, right? And how are you working on solving it? How are you working on getting world class talent into your ecosystem? How are you working on getting world class VCs to do follow on into your companies or expand your LP networks and so on? So that was kind of the genesis for us hosting it. We really want to advance the company creator category. We're hosting it again this year, May 6th and May 7th in New York. We expanded it to 2 days. Day one is only for company creators to talk about kind of headwinds and best practices. And then day two is the full blown summit. We're going to have 150 people there. Again, 50% LPs, 50% GPs. We have people coming from over 15 different countries. We have university endowments joining us, state investment councils, some large family offices, and then a lot of the company creators that we mentioned today on the podcast also joining us. So it's a great event to come together to learn more about the category, to learn about what's working, to learn about what's not, and to meet people that are interested in the category and learning more. So Sarah and I plan to kind of expand and build this event out into the future. This year was a big step up for us, moving to 2 days, and it's something that we're really excited to build as kind of like a cornerstone of hopefully the company creator ecosystem.
Within the LP world, I feel like you all are the only fund that is focusing on company creation and finding the best company creator funds. Is that a good read? And if so, how has it been in terms of engaging with traditional LPs? Do they also quickly grasp the opportunity?
Yeah. So, to our knowledge, we're the only fund of funds exclusively focused on the company creation strategy. Um, there are others, including some pretty large university endowments and family offices, that are investing in venture studios domestically and internationally. It's just not, kind of like a core part of their portfolio or their exclusive focus. One of the things that Sarah and I have experienced kind of through the life cycle of Volt is there's a real education hurdle in explaining the company creator model of like how does it even work? why does it work, and then kind of once people have grasped that, then hey, the just world of company creators is so disparate that then it's kind of like, okay, once you understand the model and once you believe in the model, kind of where do you go from there? And Sarah and I have spent a lot of time talking to LPs kind of like across the LP universe about the advantages of this model, about some of the managers that are just doing incredible work. And we are really firm and strong believers that if you're an LP investing in early stage venture, company creation needs to be part of your exposure. It's a changing trend in how early stage venture is being done, and it generates some massive alpha. We fairly consistently see triple digit net IRRs in the early years of our managers, and I know IRR is a time bound metric, but it just shows you the power of that 0 to 1 muscle that a lot of these company creators have. So I think LPs are starting to see it and starting to understand it more. But I would definitely say, some of the more active LPs in the space are definitely family offices.
What makes a venture studio successful? In your 2023 Company Creator Insights, you highlighted a few. I'm curious for you all at this point, what makes a venture studio successful?
Yeah. So this is another one of those things that has evolved for us over time. If I were to say three things, I would say talent, talent, talent. But after talent, it's the process and the rigor. And then, definitely third is the structure. But the reason that we really focus on talent and process is it's not easy, but it's common to have a handful of ideas, maybe two, three, four ideas, and have two, three, or four venture scale CEO level talent people that are in your network, right? That you're like, hey, I'm going to build this company, and I really want Tim to come and work on it, and I know Tim, so I know he's going to do it, right? Kind of once you get out of that first concentric ring of talent, where do you go from there, right? Do you work with a recruiter? Do you post the job on job boards like, hey, come be the CEO of this company? The answer more often than not is no. That's you need to kind of keep building concentric circles of talent, right? Until you get the flywheel spinning of, hey, we've built several successful companies. Like, let's just take Atomic for example, right? Atomic has a true talent flywheel. They've proven that they can build these companies. They've proven that they can scale them. So talent wants to work with Atomic. And kind of until you get to that flywheel, you need to focus on building the concentric circles. And the studios that can do that with really high level people typically succeed. And then, Sarah and I talk a lot about process. I mentioned one of the really cornerstone advantages of this model is efficiency, and you can't have efficiency without a process, right? The best company builders in the world are pretty focused on what they're building, and like a good example is Dispirited out of Miami. They're building in value-based healthcare, and like they know how to build in value-based healthcare. They know the metrics to see. They know how to diligence. They know the players in the market. So it's the process of like knowing how to ideate, knowing how to validate the problems, doing it with very little capital, and then having the right partners to kind of like go to market and really hit the gas on these companies is huge. And then third, I mentioned just the structure. The structure needs to be fair and equitable to everyone around the table, to the LPs, to the team, and it needs to not be complicated. But it's really overarchingly talent and process. If you have the right talent, they're going to build world class companies under your banner. And one of the things that we've learned, and that the venture studio market is starting to learn, is good talent, world class talent, is worth paying for. Right? Give them the right amount of ownership to be incentivized and to really have skin in the game to build these companies, to be the companies that we've mentioned like Snowflake, Hims, OpenStore, and so on.
Francisco, this has been a fascinating conversation. I definitely want to continue this because there's so many more questions I have just around founder selection in venture studios for traditional VC, how venture studios compete or collaborate with traditional VCs. Um, I'm really excited about your conference next month. It'll be my first time going to the Global Takeoff Summit. Thank you so very much for taking the time to chat with us at Advancing VC. You all are definitely advancing venture studios, and it's really cool to see that.
Thank you so much, Tim. It's been awesome to have this conversation. We're excited to see you at the summit, and yeah, this is an evolving sector, and I think that's what makes it exciting. So, thank you for having the conversation and for having me.